Earlier today, before the market opened, SoFi fell over 15% on an announcement of their intention to offer $750 million worth of convertible senior notes due in 2029. They're essentially raising money, and this is dilutive to shareholders. This is not good, and that's why the stock fell so much. But there is a silver lining to this entire mess. I've skimmed line by line the press release and have presented all the findings in a visual way for you to understand to make it super easy. Let's dive right into it. So here we have both the press releases released today. One was released in the morning, and then the other one was released slightly after with the details. It's actually the second time I'm recording this video because these details are pretty invaluable, and I want to make sure that we can actually walk through all of this. So essentially, what this deal is SoFi announcing their intention to offer $750 million worth of senior notes. Basically, these are IOUs that SoFi is offering to institutions, and they're collecting $750 million in the form of debt. Essentially, they're collecting that money. So the confusing part about this press release is that it actually includes two announcements. And one of the announcements doesn't really have a lot to do with the 750 million. It's just bundled together. So we'll cover that first so that there's no confusion. So essentially, the first announcement is SoFi is issuing 61.7 million shares so as to pay off $600 million of past debt that they had. So basically, SoFi had these senior convertible notes due in 2026. And what they're doing is they're diluting shareholders by issuing 61.7 million shares on the open market and collecting that money and then using that money to pay off the convertible notes, and the notes are essentially retired. So in the past, SoFi essentially got $600 million. Institutions got that IOU, and that was convertible. I think it was $22 a share back then and converted into shares. However, stock price has taken a tumble, and as a result, these institutions want their money back. The interesting part on this was it had 0% interest, which begged the question, why would they do this now and not wait until maturity in 2026, right? Now, in terms of the dilution, there's about 6% dilution, and there's not really too much that we can do about this. They're issuing shares, they're diluting existing shareholders. It sucks. I get it. If the stock price keeps falling, actually, based on this paragraph, it can even be slightly more than 6% dilution because they say here that the final aggregate number of shares is going to be based on the daily volume average price per share over a specified period. So it's not actually fixed at this amount. If the stock price actually falls quite a bit more, it could even be more dilution because you have to issue more shares. Now, essentially, where did this 61.7 million come from? Well, it came from the closing price yesterday, which was $8.58. They're essentially paying off $600 million worth of debt with only 529.5 million. So 89 cents on the dollar to buy back all of that debt. Why would institutions agree to that? 89 cents on the dollar? Well, it's basically the time value of money, right? We're in 2024. Why would they wait until 2026 for the full 600 million when they can get 89 cents on the dollar 2 years earlier or a year and a half earlier? So essentially, there's an opportunity cost in that money. Now, the other thing I want to mention is that obviously more dilution affects EPS negatively. This is basically the reverse of when companies do buybacks. So when buybacks happen, it reduces the number of shares outstanding, makes the EPS number look bigger. But when companies dilute, it increases the number of shares outstanding, makes the earnings look smaller. This came from a post that Data Driven Investing posted on Twitter, attached to a great thread, which I suggest everybody read on this same topic, but basically highlighting how the EPS differs here on a diluted and on the basic level. So on the basic level, you can see 4 cents EPS, and then on the diluted level, you can see 2 cents EPS, and that's basically the difference. This shouldn't be a big impact, but essentially the takeaway off the first announcement is SoFi is diluting shareholders by issuing more shares so that they can retire their 2026 convertible notes. However, that's not the title of this. It's not the main headline here. And the main headline here is really that they are announcing new convertible notes due in 2029, about $750 million worth. So they're raising money. Now, let's dive into that. So essentially, SoFi is having these convertible notes, basically IOUs, and they're selling $750 to $862 million worth of them to institutions, and institutions are buying that and they're giving SoFi the money. Some of the terms of this is that there's going to be semi-annual interest. We're going to talk about that. And the maturity is going to be on March 15th, 2029. Now, essentially, these institutions, because they're convertible, what that means is at some point, they can convert this into SoFi stock. Or in the case that we just walked through with the 2026s, they can just get cash. So in this case, SoFi issued more shares to the market to pay off this debt in 2026. So institutions got cash essentially. However, if the stock is above a certain price, institutions can convert into shares. And this is obviously preferable to them because the shares go up in value and it's obviously more money than they would get if it was just the interest payments. However, the problem is if institutions convert all of this to stock, then the shares are diluted, right? Because SoFi has to issue these shares on the open market. So at a high level, that makes sense. SoFi is raising money and they're issuing these 2029 convertible notes. At some point, institutions have the option to convert them into stock. Let's take a look now at the deal terms. And this is also why I had to record this video a second time so that I could highlight some of these terms. I drew a little timeline from today all the way to March 2029, and I have SoFi here and I have institutions here. Basically, at any point from today until 2029, SoFi can buy back these notes, but they can only buy back the notes if it's over 30% of the conversion price. So in the second press release, SoFi did give us the dollar amount of this conversion price, and I just did the math for you. SoFi can essentially only redeem these notes. They can buy them back from these institutions if the stock price is $12.28 or higher, because that's what a 30% premium on the conversion price is. Why is there a 30% premium on the conversion price? Well, it basically disincentivizes SoFi to redeem and it makes it safer for the note holder to hold these notes because they're collecting an interest over this entire time, and SoFi is only allowed to pay them back if they're actually 30% premium to whatever their conversion price is. So from today all the way until March 2029, the holders of these notes, the institutions that are holding them, get a 1.25% per year semi-annual payment from SoFi. Now, in 2028 is essentially the time when institutions can convert the notes, which are debt, into common shares. The press release highlighted that note holders can exercise only on certain circumstances and time period until one business day before September 15th, 2028, and any time irrespective of circumstances after September 15th until March 15th, 2029, so until the expiry date. So basically, if we put all of these things together, if let's say stock price hits $12 a year from now, right? Let's just say it hits $12 at this point, $12.33, then institutions at this point cannot convert into shares, but SoFi can buy all of this debt back because if they think the stock price is going to increase, if the stock price, is going to be, let's say, $25 a share here, they essentially are buying back all of this debt and they don't have to issue more shares, thereby not diluting existing shareholders. And so this does matter. And that's why you have that 30% premium, because essentially these institutions, even though they can't convert the notes into shares, they still get a 30% premium plus the interest payments for that period of time until SoFi buys back all the notes. And so it incentivizes the note holders. So essentially, SoFi can retire these notes before they become convertible. Okay, so now that we talked about some of the terms of the deal, let's go into what SoFi is using this money for. So 750 million is going to be split into a couple of different buckets. Let's first start with the preferred shares. So 325 million is essentially SoFi redeeming preferred shares that are resetting in May. So currently SoFi has about $323 million worth of preferred stock outstanding. This is preferred stock. This basically pays a 12.5% yearly interest to the people that are holding this stock. SoFi is paying for this out of pocket, and that's coming out of their bottom line. It's about $40 million per year in interest payments, or 4 cents EPS a year. The reason they're doing this deal now is because these preferred shares reset in May for another 5-year term. And essentially, SoFi is going to be locked in for another 5 years. However, this can be redeemed. And what that redeemed means in this case is SoFi buying these shares back and retiring them essentially in May. If this is not done, the interest rate increases to 17.5% for the new term. Once it resets in May for another 5 years, the interest rate bumps up from 12.5% interest to 17.5% interest. And if this is redeemed later, all 5 years worth of interest must be paid because they're essentially locked into a new term. They can't decide a year from now that they want to redeem this. They have to either redeem it now or they have to redeem it in 5 years. meaning that there's a very small window for them to buy all of this back before the interest rate increases. And essentially, the result of this is SoFi is paying off this high interest old debt with lower interest new debt. So the 2029 notes have a 1.25% interest rate. The current preferred shares have 12.5% per year. This is massively beneficial because SoFi essentially the difference of that goes entirely into their bottom line. Essentially, the gap net income for Q1 is going to be no interest payments on the preferred shares. So they're no longer paying 12.5% interest on this preferred shares because they're paying them off, but they will be paying 1.25% interest on this debt until 2029. It's still massively beneficial though because of the difference, right? You're having a massive spread there. So that's one of the benefits of doing this deal. And why they had to do it right now is because the terms reset in May. These original preferred shares essentially started in May 29, 2019, and every 5 years from there on forward reset with new terms. The other 346 million they're using for general corporate purposes and to retire additional debt. And per the terms in this press release, they highlighted that they're going to be buying capped calls to offset that dilution of about $78 million. Now, what's a capped call? I think this is the really interesting part of all of this news. Essentially, what SoFi here is doing is they're buying call options that are capped at a certain price. So think of this as like a covered call situation. So essentially, what we know is that these institutions get these notes, and this is debt. And at $9.45, that's the conversion price. At that point in 2028, the institutions have the ability to convert these notes into shares. However, SoFi buys call options from the underwriter. I'm guessing they do that at the conversion price as like the strike price, but these calls are capped. So the gains are capped at a certain level. And that price is $14.54, which is exactly double the amount of the closing price today. Let's say SoFi stock hits $9.45. And then let's say the note holders want to convert the notes into shares, right? At $9.45, they can convert them into shares. Now, what's going to happen is SoFi is going to have to find these shares somewhere. So generally what's going to happen is they're going to have to issue these new shares. They're going to have to create them out of thin air. And as a result, diluting everybody else. However, since they have call options, they can then convert those call options into shares and then give those shares to the debt holders, the ones that are holding the notes when they're converting. And by doing that, they're essentially not diluting because they're not issuing new shares. They're just converting their call options into shares. The reason why these calls are capped is because at a certain strike price, at $14.54, essentially, if the stock hits that amount, they essentially have the full amount needed to offset the 750 million in terms of gains. Anything above that strike price is just gravy on top. And SoFi doesn't necessarily need to take on that risk, nor will the underwriter allow that, because essentially, if SoFi is buying these call options, then somebody is writing the call options. And if the call writer or the broker essentially doesn't have a cap, then essentially SoFi has unlimited upside if the stock goes to 25 or 30 or $40, meaning that the call writer has unlimited downside. So obviously there needs to be a cap. And that cap in this case is $14.54. Now, it's up to SoFi to choose at what point they exercise these calls, but it's really going to depend on when the note holders convert their notes into shares. Because at some point, this is going to hit $9.45. And what's going to happen is all the people that are holding these notes are going to say, okay, I want shares now, convert them. And that would force SoFi to sell their options so that they can get the shares to give those shares to the note holders. And so really the note holders are in control here of when SoFi sells those underlying options. Ideally, SoFi wants to set this up in such a way that they have the most amount of coverage. So essentially, let's say the stock is at $7.27 right now. SoFi buys these call options, and as the stock price goes up, SoFi makes money off of these call options. And then at some point, the note holders are going to say, okay, we want to convert our notes now. We want shares. SoFi sells and then gives those shares to the note holder. So essentially, SoFi is incentivized to let this ride as much as possible so as to augment the full 750 million that these note holders have in debt. Because let's say if these note holders want to convert their shares at an earlier point in this cycle, they dilute by a certain percentage, but they don't dilute by the full amount. And so the longer that they can let this ride, the more they approach that price of making more gains so that they dilute less. And that's the entire concept at least. And so they're buying call options so that they can convert those options into shares and then give them to the note holders, thereby not issuing new shares to dilute the existing holders. I recommend Bruce's video on this. This was really fantastically explained by Bruce, and I'll add that into the description at the end of this video. Essentially, Uber did this exact same thing. Bruce talks about this in his video. Uber has had tremendous performance since that time when they offered this. Their deal was completely oversubscribed, so there is a good chance that SoFi's deal will be oversubscribed as well. Some of the benefits here is it locks up a bunch of shares. So I just did 1 million shares for the sake of simplicity, 750 million that they're raising at $7.50 stock price. What happens is the broker buys these shares in blocks at today's prices and holds them just in case they have to pay them out, right? So the underlying shares have to be held by the broker at some point or another. And essentially, this is 10% of the float, right? That's locked up by the broker. It's not tradable. The reason why this is interesting is because there's 158 million shares sold short right now. If you have 100 to 110 million shares taken completely off the market and being not tradable, that could really spell trouble for some of these shorts because it really lowers that tradable float essentially. This is my speculation, but I also think that this could serve as incentive for a buyer of that debt because there's such a high short interest. And because so many shares are going to be taken off the market by the broker, it could actually lead to an increase in price due to that shock value from the shorts not having as much liquidity to play around with. Bruce also mentioned that, management can't talk about any of this right now. It's a blackout period, which I totally forgot about this morning. And then brokers also need to buy the shares once the deal is finalized, because right now, this is only a proposal for the deal. The deal is not finalized right now. It's essentially going to go on a roadshow. SoFi is going to be working with underwriters to essentially find a buyer for this. The other benefit is that dilution is capped due to this call option strategy. So because SoFi is spending 78 million here to buy these call options, then that offsets how much dilution they're eventually going to have. You might get partial dilution, but you're probably not going to get the full amount diluted depending on what the stock price ends up at. The third benefit is that institutions are incentivized to convert the notes because they just make more money than they would with just the interest alone. The fourth benefit here is that once these are converted, these shares go to long-term holders. These institutions, first of all, the broker has to hold all of these shares until that conversion happens. But even after that conversion happens, if it happens, then these institutions are like pension funds, retirement funds. They're not the average everyday retail investors that buy and trade on any given basis. They'll hold them for the long term. The other benefit is that, we're getting rid of expensive old debt with cheaper debt. You go from 12.5% interest to 1.25% interest per year. And on top of all that, you're also getting a benefit for the bottom line because that's $40 million that, goes essentially to the bottom line roughly in terms of the EPS because you're no longer paying that 12.5%. One thing I will highlight is the worst case. So if the stock doesn't hit the conversion price by expiry, which is $9.45, SoFi was going to have to dilute even more to redeem the notes if they don't use cash on their existing balance sheet to redeem. And also the $78 million in call options expires worthless. So they just waste that money. I think that this is honestly a really smart strategy. I think it incentivizes institutions to have a vested interest to drive the stock higher. And it takes a whole bunch of shares off the market. And it does so in such a way that SoFi can pay off all of their bad debts. It's just smart from a lot of angles, depending on how you slice it. I hope this video has been helpful to sort of break it down in a more visual way and explain it a little bit more granularly. I'm not a financial guru by any sense of the imagination. I've spent way more time than I care to admit, tonight researching this stuff. And I recommend you watch Bruce's video. I recommend you check out Vadim on Twitter. You check out Data Driven Investing, Chris Hager. You check out Sam. They're all going to be tagged in the description below. They all had great write-ups earlier today on this. More technical than I could ever wish to make a recording about. But I really wanted to break it down in a visual way because I just learned better visually. And and I saw a bunch of comments on my Twitter that said, can you explain this like I'm 5 essentially? And so I hope this video helped. If it did, share this out, drop a like, subscribe for more videos around SoFi specific content. I bought more SoFi shares today. I think this is massively positive news because of what it means and because of all of those shares essentially that are going to be locked up because of that old bad debt, high interest debt that's getting replaced by this lower interest debt. There's a lot of things to love about this deal, but obviously it is dilutive, especially the first part of the deal, the 600 million. So that's obviously not great for the market to see, and which is also why the stock price was down so heavily today. But if you're a long-term investor and if you believe in the trajectory of the company, then I think this is a massively smart move by management team. Obviously, they can't comment on it because it is a blackout period at the end of Q1, which also made me want to make this video so much more so that I could hopefully lend some explanations to some of the moves that were done. But anyways, now I'm rambling. For right now, this is the Fundamentals Investing Podcast. Thank you so much for listening.